This video is sponsored by BMO ETFs. Gold prices have soared in the last year or so. For the record, I'm filming this on July 21st of 2025. But if we go back, you could actually see that physical gold actually also has a strong historical performance versus major indexes, for example, like the S&P 500. So this chart goes back all the way towards to 2006 until May 7th, 2025, and you see that the average annual return of gold actually beats or outperforms the S&P 500, and you see that really big spike in the last year or so. So one of the ways an investor could easily get access or conveniently get access to physical gold is via the BMO Gold Bullion ETF, ZGLD. So this ETF seeks to replicate the performance of the price of gold bullion net of fees and expenses by investing in long-term holdings of unencumbered gold bullion, etc. So this is literally, by owning this ETF, you are diversifying your portfolio, like it says here, with physical gold. The physical gold is actually held in a local BMO vault. And if we look at the performance of this ETF in the last year, as of June 30th, 2025, you see over 40% return, which is very, very good. And for the record, the management expense ratio is only 23 basis points on this ETF. So, for example, if you're investing $1,000 into this ETF, the fee that you're actually paying is $2.30. So this could be a convenient way to invest in physical gold without actually buying, the gold bars and storing them and paying with the fees associated with that. But what if you're a cash flow investor like myself? What if you want to add some physical gold to your portfolio, but you are a cash flow investor? Enter the BMO Covered Call Spread Gold Bullion ETF ZWGD. So this is definitely not BMO's first covered call ETF. They are actually the biggest provider in Canada in terms of AUM for covered call ETFs. And by the way, you could find them all here if you go to their Find an ETF tool, which I'll put the link in the video description below. In strategy, if you select enhanced income, you will get their list of covered call ETFs. So ZWGD is their latest one, and it's the first one that uses a covered call spread strategy, which we're going to explore in detail. This ETF, by the way, came out on May 22nd, 2025. So let's look at what this ETF is all about, everyone. First of all, the management expense ratio, 73 basis points. And if we look at the overview, the portfolio strategy, the ETF seeks to provide long-term capital appreciation through exposure to the price of gold bullion by investing directly or indirectly in long-term holdings of unencumbered gold bullion. And here's the cash flow part. And to earn premiums through exposure to a covered call spread strategy. So if we look at the fund benefits, right, this is really to diversify your portfolio with physical gold exposure, right? But the difference between the first ETF that we looked at is exposure to the price of gold bullion, like the first one, but this one with an income enhancement. So that's really the difference. So what is a covered call spread strategy? How is it different from a classic covered call strategy? Well, the first thing I always look at, everyone, when I'm exploring or trying to understand a new ETF is always to look at the holdings. What is inside this ETF? And you will quickly see that the major holding is actually in the ZGLD ETF, the BMO Gold Bullion ETF. And what they're doing is they're writing covered calls. They're doing a covered call spread strategy on that ETF. So that is where they're actually selling the calls on this ETF in particular. And let's take a look at an example of a covered call spread, because you could see it right here in the holdings. I'll make it a little bit bigger so you could see that. So first of all, when you're selling a call option or writing a call option, that is where the premiums come in, right? That is where the cash flow comes in for a covered call ETF strategy. And you see that here. When you see that it's in the negative, right? The call option is in the negative. That means they sold the call option. So in this case here, for this call option, the expiry date is July the 18th. So by the way, next time when you look at this ETF yourself, it'll probably be gone, but either way, we could still look at it as an example. So July 18th is the expiry. Of course, they're doing the call option on the ZGLD. And here's the important part, the strike price. The strike price is $50.25. So in a regular cover call strategy, when you're writing a call and the strike price is $50.25, you're basically giving up the upside past $50.25, right? But in this case, when you're doing a cover call spread strategy, you're going to be selling a call option, but in parallel or simultaneously buying a call option as well on the same holding, right? In this case, ZGLD. And here is the spread. Here it is right here. So you see that this is not a negative, which means they bought the call option. So the call option is on the books, if you will, within the ETF, on the books of the ETF. So you see that it's positive instead of negative. And you see that the strike price is going to be higher, right? So a call spread, typically the strategy is you're selling a covered call at a strike price, and then you're going to buy a covered call. You're going to buy a call on the same asset at a higher strike price, which is the case here. The strike price is $51.75. So basically, let's just say within that month, using this example, within the month of July, let's say gold spikes to $53. Well, if you would have just done a covered call at $50.25, you would give up all the upside past $50.25. By the way, when I'm saying $50.25, $51.75, this is referring to the call option, but it's the strike price of the call option, but it's referring to the price of the ZGLD ETF, right? So let's just say, for example, it goes to 53, it spikes within that month. Well, you would be giving up a lot of upside if you're just selling a covered call at $50.25. But what they're doing is they're doing a spread. This is where the spread comes in. The spread is really between 50.25 and 51.75 here. So what happens when you actually buy a covered call, or you have one at 51.75? Well, if the price of gold spikes and, for example, ZGLD goes to 53, you're actually going to be capturing that upside thanks to that 51.75 call option, right? You're going to be able to exercise at 51.75 instead of 53. So you're going to be capturing that upside. So think of a call spread. When you're doing a regular cover call strategy where you're just selling a call, you're limiting your upside to the strike price of the call that you sell. In this case, it would be 50.25. When you're actually buying a call as well in parallel, let's say at this example, 51.75, it's kind of protection in case there's a spike in the price. You'll be able to capture that upside past 51.75. So hopefully you understand what a covered call spread strategy is. Again, just to recap, it's basically when you're writing or selling a call at one price and you're purchasing a call option at a higher strike price. So this is the strategy of this ETF. The distribution frequency is monthly. And by the way, they've actually declared their first distribution here at 12.5 cents a month. So now let's talk to a portfolio manager at BMO, and we'll figure out and find out all about this ETF. All right, everyone, I am here with Jonathan Lau, portfolio manager at BMO ETFs. How's it going, Jonathan?
Going very well. Thanks for having me here today, Adriano.
Thanks so much for joining us today. So why don't you, since it's the first time on the call, introduce yourself, if you don't mind, since it's the first time on the channel, rather, introduce yourself real quick to the audience, if you please.
Sure thing. So hi, everyone. I'm Jonathan Lau, portfolio manager on the nonlinear ETF team here at BMO Global Asset Management. I have over 15 years of portfolio management experience in the derivative space. So most recently, I spent over a decade at a major bank-owned asset manager, designing and managing derivative strategies for retail and institutional clients. So that's 1 decade. And then prior to that, I spent about 5 years at a major Canadian pension plan, mainly focusing on the foreign exchange and the future space. So, yeah, I would say all in all, I have been living and breathing in derivatives throughout my entire career.
All right. And when you say derivatives, that options falls into that category, just in
Of
case my audience doesn't know. Perfect. So let's just get going right away. Why did BMO decide to launch the BMO Covered Call Spread Gold Bullion ETF? We're talking about, of course, the ZWGD ETF here.
Yeah, sure thing. Historically, BMO has been one of the strongest leaders in the ETF space, and our proven track record goes all the way back to year 2009. So here at BMO, what we want to do is to be able to provide clients with investment strategies that fit well in the current landscape. And if you look at where we are today, we are living in a world with a lot of uncertainty, whether it be trade related tensions with the United States or just managing our own lives through periods with high inflation, like what we just did in the past few years. And during these periods of high uncertainty, we know that investors are always looking for ways to better diversify their portfolios. So, with this backdrop, investing in gold has gained a lot of popularity in recent years. Now, that being said, one of the commonly known drawbacks of investing in gold is that it typically doesn't pay any yield. So it's a
Mm,
yieldless asset. So to address for this, what we wanted to do is provide investors with an innovative approach to invest in gold. And what we want to solve for is to come up with a gold-based product that pays some sort of distribution, but without taking away the traditional benefits of investing in gold. So, with the launch of ZWGD, we have essentially transformed gold from a yieldless asset into a strategy that pays a monthly distribution. And we do believe that a lot of investors out there will appreciate the fact that they can now invest in gold while simultaneously collecting a yield.
perfect. All right. Thanks for that. So this is BMO's first covered call spread ETF, right? So why did you guys decide on this approach, for example, for this ETF versus a more classic covered call strategy like the rest of BMO's covered call ETFs?
Yeah, so maybe let me just start off by, level set and explain how our covered call strategies typically work here at BMO.
Yeah.
So to begin, we'll begin by owning the underlying. So in this case, it would be the ZGLD ETF, which provides exposure to gold and also exposure to the US dollar for Canadian investors. And then on top of that, we'll write out of the money call options on approximately half of the gold exposure we own. And what I mean by out of the money is that the strike level of the call option that I sell is above where the underlying is currently trading at. So this is basically a nutshell of how the current cover call strategy works for our existing suite of cover call ETFs.
Yeah.
Now, on top of this, we now add an additional twist to make it a cover call spread. We now go out and purchase a second call option that is further out of the money than the call we just sold. And this selling and buying of call options is what makes it a cover call spread. Now, to answer your question, why we decided to go with a call spread for gold specifically, I wanted to go back to the reason why investors wanted to own gold in the first place, which is to give themselves strong downside protection during times of uncertainty. It could be when markets are falling or when inflation runs high. So, our view is that investors want to retain that strong upside in gold when the world is really not doing well. So, in the process of designing a product for gold, our team took a very careful look at the historical monthly return profile for gold. And what we observed was that when we compared that to equities, gold's historical return tends to be frequently muted, but then it comes with very occasional spikes of strong performance.
Mm,
So, given that gold behaves very differently than equities, and after all, it is a different type of asset, it naturally makes sense that the option strategy should also be different. And in fact, the team here views that our cover call spread strategy as a natural evolution from our existing suite of cover call ETFs. So again, our view is that when investors invest in gold, they want to retain that upside when gold goes up a lot. So by buying that additional further out of the money call option, we are able to maintain that linear upside in gold when gold rallies a lot. That is why we believe that a cover call spread is the most appropriate strategy when it comes to gold.
Okay, perfect. So we know that writing covered call spreads means you're giving up a portion of the upside of the underlying asset, right? That's classic cover call strategy. That's what you're doing. But you're buying, like you said, a further out of the money call to try to limit that, and in case gold rallies, you'll capture that. So for investors that are trying to determine, okay, how much upside am I giving up? What would you say? Approximately how much upside is an investor giving up with this ETF?
Yeah, great question. So, like I mentioned earlier, with a cover call spread strategy, we are selling a call option with a lower strike and then buying a second call option with a higher strike price. Now, in exchange for that, we receive a cash flow upfront when doing selling this call spread structure. So basically, what investors are giving up is that distance between the two strike prices. And because in our approach, we're only selling the call spread on about half the portfolio, the amount that you're giving up, it's about half the distance minus the cash flow that we receive upfront when we sell the call spread. So I know a lot of words there. Let's actually go through a numerical example.
Hmm.
So let's say we have the underlying trading at $100 today, and I sold the call spread with 101 and 103 strikes. So selling a call at 101 and then buying another call with 103 strike. So in this example, what we're potentially giving up is that distance between the two strikes. So 2% worth of return. And because I'm only doing this on half the portfolio, what you're actually potentially giving up is half of that. So 1% worth of return at the total portfolio level, minus any cash flows that I just received or collected when I sold that call spread at initiation. Now, I think one thing to remember is that this number is actually the maximum amount that you'll be giving up. So in the case that if the underlying ends up lower than 103 when the option expires, what you're actually giving up will be less than this maximum amount.
Hmm.
And in fact, if the underlying ends up below 101 in this example on expiry day, you're actually giving up nothing.
Right.
And on top of that, you also collected additional cash flow when selling that call spread. So on the other hand, what happens to ZWGD when gold is up a lot? So when the gold market is up strong, so in this example, when the underlying ends up above 103 on expiry date, the cover call spread investor will still retain decent participation in the upside in gold, but will slightly underperform the traditional gold investor. But again, what I really want to emphasize here is that there's a cap on this underperformance. So as an illustrative example, if I go back to what I used earlier, let's say the maximum underperformance for a particular month is capped at 1%. So then in the following month, if ZGLD is up 10%, we expect ZWGD to be up 9%. However, if ZGLD is up 20%, then we expect ZWGD to be up 19%. So you can see that underperformance against ZGLD is capped, and it does not grow as gold market goes up more and more. So this really ties back to my point earlier that the cover call spread strategy is able to keep up and retain the strong upside in gold when investors need it the most. And I
Yeah.
think and I think at the end of the day, there's really no free lunch. So all income enhancement strategies do involve some kind of a trade-off between current income and future potential growth. So what we've done here for ZWGD is to pick an appropriate option strategy that strikes a good balance between income and growth, and at the same time, it fits well with the underlying characteristics of gold.
That's perfect. I love that example where in that month gold rallies really, really high. So in case it does, because you're actually buying an out of the money call, you're kind of limiting the limit of the cap that a regular cover call strategy does. So I really like that example. So in case in 1 month gold rallies, you're only giving up 1% of that essentially.
Exactly.
All right, perfect. That makes sense. So the first two distributions were declared for this ETF. What would you say to investors, especially my audience, because they're income-oriented investors, relating to the distributions of this ETF? And maybe after that we could discuss how this gold, covered call spread strategy maintains the, if it maintains the known tax benefits of the other BMO covered call ETFs, the ones that use more of a classic strategy.
Yeah, sure thing. So, from a cash flow perspective, what
Hmm.
investors can expect is to receive cash flows on a monthly basis. So, like you've mentioned, since ZWGD has been launched, the fund has already paid out the first two distributions,
Hmm.
one in early July and then the next one in early August. And our expectation is to keep this distribution percentage stable over time. So what that means is, over time, if the price of gold goes up, then we do expect the distribution amount to also correspondingly increase as well. You also asked about the tax aspect. So,
Yeah.
from a tax perspective, similar to our existing cover call ETFs, the cash flows that we receive from the cover call spread strategy is typically treated as capital gains. So, for clients out there who hold the ETF in a non-registered account, this amount of cash flow would be taxed more efficiently when you compare it versus the same amount of interest income that is generated from a fixed income or GIC portfolio.
Okay, perfect. So yeah, options in Canada are treated as capital gains income, right? So if you hold this ETF and you're non-registered, like you said, you still have the same benefits, where the income is going to be treated, or the distribution rather is going to be treated as more as capital gains, not like regular income, like a fixed income or bond type of product. So those are all the questions I had. You answered everything. Now it makes more sense of why you guys decided on a spread strategy for this particular asset class for gold. I think income investors are reassured because yes, you're getting that monthly income, but in case gold has a big rally, which you guys have done obviously the research that it could happen, right? There's some bad news and boom, gold rallies. You're not going to give up you're going to give a little bit, obviously, but not a whole lot. So thanks so much, Jonathan. Hope to have you on the channel again. And yeah, thanks so much for your time.
Thank you.